Welcome to Introduction to Bonds. Bonds are a subject that have been near and dear to our hearts here at PIMCO for close to 5 decades, and we're glad to have the opportunity to discuss this with you today. Our goal is threefold. One, we're going to spend a few minutes reviewing bond market basics. Two, we're going to take a look at why you may want to consider investing in bonds. And three, we're going to review how bonds fit into your overall portfolio. Let's begin with the basics. When you invest in the bond market, you are essentially loaning money. The bond market takes large loans, breaks them into pieces, and turns them into tradable securities. The length of these loans varies and is known as the maturity of the bond. Common maturities include 5, 10, or 30 years. The amount that the bond market borrower repays at maturity is called the principal or face value. The interest payment that the borrower makes, often semi-annually and expressed as a percentage of the face value, is called the coupon. The term coupon comes from the fact that years ago, investors would actually cut coupons out from a certificate that looks like this and present it to the issuer for payment. Here you see an illustration of the concepts of coupon, maturity, and principal. Another important term is yield to maturity. Yield to maturity is the estimated rate of return for a bond, assuming an investor holds that bond until its maturity date. The yield of the bond is related to the coupon rate, but can sometimes be quite different as it factors in the price that you actually paid for that bond. Bonds can sell at a discount to par value, and bonds can sell at a premium to par value. So who borrows in the bond market? Turns out that the U.S. government is one of the largest and highest quality borrowers globally. The U.S. government borrows to fund programs like national defense, Medicare, and Social Security. A second major sector here in the U.S. is the mortgage and asset-backed market. This market provides funding, often to consumers, for home loans, car loans, credit cards, and other needs. Corporations represent a third major sector. Companies often borrow money in the bond market to build new facilities, grow their businesses, and to fund day-to-day operations. How big is the bond market? The bond market is large. In fact, if you look at the green bar here, you see that at $38 trillion, the U.S. bond market is much larger than the U.S. stock market, and that at $110 trillion, the global bond market is larger still. This $110 trillion market is very diverse. The U.S. is the biggest piece, but Europe and Japan have large bond markets also, representing 19% and 12% of the market respectively. Note here how China represents 13% of the global bond market. This size and scale creates a rich opportunity set for all of us as investors. Earlier, we covered the concept of yield to maturity. Let's see what happens to bond investors when yields move around a bit. Here we see, for example, the price of a 2-year note with a 2% coupon in different yield scenarios. Let's say I buy this 2-year note for $100 and then interest rates fall to 1% as shown here in green. It turns out that move makes me quite happy as I now have in my possession a note that pays 2% when comparable notes in the market pay only 1%. And given how much more attractive 2% is relative to 1%, investors are now willing to pay me a premium price, roughly $102 if I tried to sell my note. If, on the other hand, I buy my 2-year note, then the yield on comparable notes moves up to 4.6%, I am now quite sad. In fact, investors would now only pay me $95 if I went to sell it. It is this relationship that sets up the teeter-totter concept that many investors are familiar with. If interest rates move up, bond prices move down, and vice versa. If interest rates go down, bond prices generally move up. Duration is a term that is used to measure the strength of this relationship. Duration, measured in years, estimates the percentage change in a bond's price for a 1% change in yield. This is an important measure of risk that is often prominently featured on fund fact sheets. Note here, for example, a bond with a duration of 5. If interest rates were to fall by 1%, this bond would go up in value by 5%. As bond investors, we face risks. One is interest rate or duration risk, as we just mentioned. We also face the related risk of inflation. Inflation is the risk that money paid back to me when my bond matures in the future will purchase fewer goods and services than it does today. Default is another risk. If I lend money to, say, a corporation, it is possible that company may run into stress down the road and may not be able to honor their obligations to me as a bondholder. All of this begs the question, well, if there are so many risks, why do investors allocate to bonds? The good news is that, in short, there are also benefits, opportunities, and certain protections for investors. Investments in U.S. Treasuries, for example, are backed by the full faith and credit of the U.S. government. Investments in municipal bonds are backed by the taxing authority of state and local governments. Investments in corporate bonds are backed by the financial strength of the issuing company and, in some cases, by hard collateral such as commercial real estate. In addition, in the event a company runs into distress, bondholder claims are generally viewed as senior to those of stock investors. Here you see an illustration of those potential benefits. In green, we see returns for the stock market represented by the S&P 500 during some tough periods, including the 2008 financial crisis, shown here on the far right-hand part of the page, when stocks fell by 55%. Immediately to the left of that on this chart, you see returns for the stock market during the COVID sell-off in 2020, where the stock market fell by close to 27% in less than a month before recovering. In the blue bars, you see the returns for a diversified high-quality bond portfolio as represented by the widely tracked Bloomberg Barclays Index during these same periods of stress. You can see that historically, high-quality bonds have helped preserve wealth, generating positive returns during these volatile periods. Next, let's review the role of bonds in a diversified portfolio. This chart shows you 20-year annualized returns and 20-year annualized volatilities for different asset classes. Volatility is a statistical measure of the dispersion of returns for an investor. 2 points here. First, compare the annualized volatility for stocks, represented by the maroon diamond, to the annualized volatility of a balanced portfolio that includes 60% in stocks and 40% in bonds. That balanced portfolio is represented by the green diamond. Note how the volatility of the balanced portfolio is much lower than that of the all-stock portfolio, providing investors with a much smoother ride over this 20-year period. Second, note how a stock investor that held a 40% allocation to bonds, again represented by the green diamond, outperformed a stock investor that held a 40% position in cash. That stock-cash blend is represented by the blue diamond just below the green one. While past is not always prologue, it is important for investors to keep this historical return difference in mind as they consider the potential role for both bonds and cash in their portfolios. A key question for every investor to ask as he or she builds his or her portfolio is, where do I want to be on the risk and return spectrum? As we discussed earlier, certain investments in the bond market, like government bonds, are defensive, whereas certain parts of the corporate bond market, for example, pay higher yields, but also expose investors to some additional risks. Some additional considerations as you wade deeper into the bond market waters. There are 344,000 issuers in the global bond market. A major corporation may have one class of common stock and at the same time have over 30 different bond issues outstanding, each with slightly different terms and legal protections. Picking the right bond requires extensive due diligence, analytics, and technology. And if you want to take full advantage of the global opportunity set, you need those resources on the ground in various regions and time zones. Complexity therefore creates challenges, but it also leads to opportunities. And because of this complexity, active management tends to work really well in the bond market. Here you see the historical track record for that. 84% of active bond managers in Morningstar's Intermediate Core and Core Plus categories outperformed the median passive fund over a 10-year period. In the ultra-short bond category, 100% of active bond managers outperformed the median passive fund. At $110 trillion, the global bond market is massive and full of opportunity. We covered a number of important terms and definitions today and learned that bonds can help us protect our principal and generate income. They also provide us with valuable diversification relative to equities and other risk assets. Thank you for your time. For additional resources and education, please visit pimco.com/advisor education.